a bank that moves more money than most countries put a number on gold, and the internet turned it into a countdown. $6,000 an ounce by the last quarter of 2026. From the mid-year tape, that is roughly a 40% spike. Then gold did the opposite. It printed a record above $5,600 in January and spent the next 2 quarters bleeding. Sit with 4 questions. Why is JPMorgan's gold call being sold as a 40% explosion in 2026? If gold already printed a record above $5,600, why did it then suffer its worst quarter in 13 years? Are central banks still buying, or did the official numbers just go dark? And after the summer forecast cuts, does $6,000 still have a path? And what would kill it? Do not answer. Gold is not a stock with earnings. It pays no coupon. When cash and treasuries pay more, it has to win on fear, insurance, or a buyer who is not trading the next Fed meeting. For 4 years, that buyer was the official sector. JPMorgan Global Research put the bull case on a public page dated June 9, 2026. The new fourth quarter 2026 average is $6,000 an ounce. 2027 drifts toward $6,300. The same table shows they had already flinched. In February, the fourth quarter box said $6,300, and the full-year average said $5,708. By June, that full-year average was $5,243. They cut the year and kept the year-end ambition. That is how a 40% headline is born. Take a mid-June spot near $4,200, or an August print near $4,340, and $6,000 is about 38% to 42% higher. It is not 40% above the January record. EBC later noted $6,000 is only about 7% above the January spot high, near $5,595. Greg Shearer, who runs base and precious metals research at the bank, did not describe a melt-up. He described a technical no-man's land. Gold above the 200-day average around $4,340, capped below the 50-day around $4,730, with investors on the back burner because the Fed might hike against energy inflation. The bank's own intra-year floor was $4,170. The explosion you are being sold is a fourth quarter average that assumes demand comes back after a sideways plod. Trading Economics logs an all-time high of $5,608.35 in January 2026. Reuters watched bullion blast past $5,500, then give back hundreds of dollars in a session. By July 1, Business Insider had gold just above $4,000, a 27% drawdown from a high just above $5,600. The second quarter fell about 16%, the worst quarter since 2013. The 50-day average crossed under the 200-day, the World Gold Council's mid-year note. As quoted there, said a modest year-to-date drop of about 7% was masking a roller coaster. Gold's 2025 bid leaned on the idea that the Federal Reserve would loosen. In 2026, the new chair, Kevin Warsh, talked like a hawk and restated the 2% inflation target. The dollar index sat near 101 in early July, up about 3% on the year. Speculative length unwound. Verified data cited by Business Insider showed gold ETFs bleeding about $3 billion in the quarter. Jewelry demand in price-sensitive Asia went quiet. That is what a no-yield asset does when real yields firm. The bank still had a floor story, and it was not Western funds. From 2021 through 2025, JPMorgan said central bank gold purchases averaged 225 tons a quarter, roughly double the prior 5-year pace. Then 2026 opened ugly on the official ledger. The June page said central banks sold 129 tons in the first quarter, headlined by Tuakea's 60 tons in March, with reported net purchases of only 16 tons. That chart is why people say the bid is dead. The World Gold Council told a more complicated story, then revised itself. In April, it estimated first quarter official demand at 244 tons, even after Turkey, Russia, and Azerbaijan sold. A large slice of buying is never reported to the IMF. Because reporting is not mandatory. The Council used London over-the-counter flows and Swiss refinery trade to guess at the missing tons. JPMorgan repeated that 244-ton figure on June 9. Then, in late July, the Council reclassified part of that activity into the over-the-counter column and cut the first quarter official estimate from 244 tons to 57. The hidden bid was real. It was not a license to treat every unreported ounce as permanent. Here is the rebound. Second quarter net official purchases were about 289 tons, up 62% from a year earlier, and a record for a second quarter. Poland added 51 tons in the quarter and 82 in the first half, taking reserves to 632 tons on the way to a 700-ton target. The People's Bank of China added 33 tons in the quarter. In July, Ray Jia at the Council wrote that Beijing reported another 20 tons, the largest monthly add since late 2023, the 21st straight month. And holdings of 2,366 tons, about 8% of foreign exchange reserves. China also imported first quarter net imports of 317 tons and 764 tons in the first half, up 138% year-on-year. A second pipe is not a central bank. In 2025, the top 10 Chinese insurers received approval to put up to 1% of assets into physical gold, about 200 tons, and those holdings are not fully disclosed. Kitco, citing JPMorgan strategists, added the thought experiment that makes $6,000 less random. If just 0.5% of foreign holdings of United States assets were reallocated into gold, that flow alone could push the price there. The European Central Bank said gold was 27% of global foreign reserves at the end of 2025, ahead of treasuries at 22%. Even so, the costume of the reserve system changed. The bear case sits in the same JPMorgan paragraph as the bull case. Because gold has no yield, a Fed that hikes against energy inflation can crack Western demand and flip ETFs into outflows. The bank had already cut its 2026 ETF inflow assumption from 580 tons to 400. In early July, Yahoo Finance and Reuters, as later summarized by Gold Republic, reported that JPMorgan had cut the fourth quarter target by about 25% to $4,500. The bank's own June Insight page was not rewritten to match. By August 10, EBC still listed JPMorgan at $6,000 as a fourth quarter average. While Deutsche Bank sat at $4,600, HSBC at $4,750, and Goldman Sachs at $4,900. Bank of America, per Business Insider, said $6,000 looked unlikely for now. The World Gold Council sketched a path that could print as low as $3,500. By mid-August, the tape had bounced. Trading Economics had gold near $4,380 on August 18, up about 9% on the month, still more than 20% below the January high. Global gold ETFs took in about $3 billion in July, though North America was still a net seller for the year. Soft jobs cut hike odds, even as the 10-year yield sat near 4.65%. That is not a detonation. It is a market waiting for easier real yields, or for official buying that Western funds decide to chase. Here is what those four questions were asking. JPMorgan's gold call is sold as a 40% explosion because $6,000 is about 40% above the mid-year spot, not because the bank promised a moonshot from the January record. The June 9 page is a fourth quarter average of $6,000 and a 2027 drift towards $6,300 after the bank had already lowered the full-year average. Gold suffered its worst quarter in 13 years because the 2025 rate cut story broke. A hawkish Fed, a firmer dollar, a death cross, and about $3 billion of second quarter ETF outflows did what a no-yield asset does when cash pays again. The January record above $5,600 was the top of a squeeze, not a floor under 2026. Central banks did not vanish. Reported first quarter numbers looked dead. 16 tons of net purchases against 129 tons of sales. The council first estimated 244 tons, including the dark tons, then revised official first quarter demand down to 57. The second quarter came back at 289 tons. Poland and China kept buying. The dark tons are real. They are revisable. 6,000 still has a path if Western ETFs return and real yields ease, or if even a sliver of foreign United States assets rotates into bullion. It dies if Warsh's Fed hikes into energy inflation and the dollar stays bid. Some desks now write $4,500 as the JPMorgan fourth quarter. The public June page still says $6,000. Treat the number as a flow model, not a promise. Gold can be the oldest insurance policy and still have a modern year of getting marked to a yield.